Going concern versus liquidation basis. Have you ever wondered how businesses decide whether to keep operating or prepare for a shutdown? The terms going concern and liquidation basis are key to understanding this. Let's break down what each means and how they affect financial reporting. The going concern basis assumes that a business will continue its operations for at least the next 12 months. This means the company expects to meet its financial obligations as they come due. Under this assumption, assets are recorded at their historical cost and depreciated over their useful life. This reflects the ongoing use of those assets in the business. When financial statements are prepared on a going concern basis, they include normal operating results, cash flows, and a classified balance sheet. However, management must assess if there are any substantial doubts about the company's ability to continue as a going concern. If there are concerns, these must be disclosed in the footnotes of financial reports. This transparency helps stakeholders understand the risks involved. On the other hand, the liquidation basis is used when management plans to liquidate the business or has no realistic alternative but to do so. In this case, financial statements are prepared with the assumption that the company will sell off its assets and settle its liabilities. This method does not use historical cost accounting. Instead, it focuses on the estimated net realizable value of assets and liabilities. When using the liquidation basis, it is important to account for estimated disposal costs and expected operating losses during the liquidation period. This basis is considered an alternative accounting framework under generally accepted accounting principles and is only used in specific situations when going concern assumptions are no longer appropriate. From a tax and accounting perspective, the choice between going concern and liquidation basis affects how assets and liabilities are valued and reported. This, in turn, influences taxable income and potential tax consequences related to asset disposals or write-downs. Going concern accounting supports ongoing tax depreciation and expense recognition. In contrast, liquidation accounting may accelerate the recognition of gains or losses due to asset sales and the settlement of obligations. In summary, the going concern basis assumes ongoing operations, uses historical cost, and requires disclosure of risks to continuity. The liquidation basis assumes cessation of operations, values assets at net realizable value, and focuses on liquidation costs and expected losses. Management must carefully evaluate the entity's ability to continue as a going concern when preparing year-end financial statements. This ensures compliance with accounting standards and provides clear information to stakeholders about the company's financial health and future prospects.